let's get this started. My name is Taylor Zork. Today we have Nick Richards on the call with us. He's going to be helping us go through some of the insights into IRS scrutiny of digital assets. So we're going to look into compliance and tax resolution insights, as well as kind of the way that things are shifting and moving. We did a presentation on this topic a little while ago, and so we are kind of revamping this presentation and seeing what other insights have come along the way since then. So without further ado, so the instructors on today's call are myself and Nick. We'll get into the learning objectives, and then we'll do a quick background on ourselves. So the learning objectives of today's call are to understand the IRS's current stance and enforcement strategies on the digital assets industry. We're going to identify the discrepancies in digital asset reporting. We'll comprehend the legal and criminal implications of noncompliance, and then learn the essentials of tax resolution work in digital assets. So myself, my name is Taylor Zork. I've been involved in the industry since early 2018, when I discovered kind of the capabilities and the tech behind Ethereum and smart contracts and all that. I kind of saw the implications for the financial system as a whole and really got interested. Started working as an accounting professional in the industry, noticed that there was a huge gap in that role within the industry, even though this is all a ledger, right? This is an accounting tool at the heart of it. And in that experience, I became the CFO of multiple different crypto startups. I have experience with multi-jurisdictional crypto organizations, and I have deep experience with DeFi, NFTs, bridges. So a lot of the kind of complex stuff that happens on chain. So that's my experience. And then I'll let Nick kind of jump in and talk a little bit about his experience.
Thanks, Taylor, and thanks for letting me be part of this. Appreciate it. So I was an IRS trial attorney for about 11 years or so. When I was with the IRS, I dealt with what was then known as ATAT. In a lot of ways, I was kind of the father of the ATAT program. ATAT was abusive tax avoidance transactions, and the IRS, when it has reason to believe that there is some sort of abuse going out there, it can start these special projects. They're known as compliance initiative projects, and essentially what happens is there'll be a few audits that are just random audits that'll reveal that a certain population is out of compliance. The IRS then seeks authority to target that population itself, and then initiates audits, and there's a team that gets assigned and all that kind of stuff. I was involved in doing a lot of that stuff with tax shelters at the time, early 2000s. Started that program, shut down a lot of folks that were promoting tax shelters. Now, since I left the government, probably, gosh, Taylor, it's got to be about 15 years or so now. Been representing taxpayers, businesses and individuals in audits and debt and trials and everything that we would call tax controversy. Basically, that's everything that happens after you file a tax return. I don't prepare tax returns myself. I'm not a CPA. I'm a lawyer. I'm at a firm called Greenspoon Marder. We're a large, what's known as AmLaw 200 firm. We're a national firm with, 25, 26 some offices across the country, and over 250 lawyers. So real happy to be here today.
Great. So the way that this discussion will go is I'm going to kind of give some background, and then we're going to lean on Nick for some kind of insights and lean on his background within the IRS as a trial attorney to kind of shed some additional light onto this. And please feel free, if you have any questions or anything comes up, throw them in the chat or in the Q&A so that we can answer those. We'd be happy to answer any questions you have. So let me just pull up the presenter view real quick so I can go to the next slide. Okay. So let's just start where the IRS currently stands. And I think for some additional context, I think it's really nice to outline a recent annual report the IRS released on December 4th. So just at the end of 2023 there, where the IRS Criminal Investigation Unit said it had initiated more than 2,676 cases in the fiscal year 2023 related to crypto assets. Which included more than 37 billion related to tax and financial crimes. The government department, the same criminal investigation unit, has seized more than $10 billion in cryptocurrency since 2015. So they're taking this seriously, and the numbers and the recent kind of actions that they've taken over the last year in 2023 are really showing that. They've got the funding, they see that there's a huge gap here in reporting. And so just to kind of lay the groundwork, I wanted to kind of bring up that stat because I think that that's really relevant and important to know. So as of right now, there's the stance of the IRS and different governing bodies is that these digital assets are classified as property. So the IRS treats digital assets like Bitcoin as property for federal tax purposes. So this means that general tax principles applicable to property transactions apply to transactions using digital assets. So I always like to come back to, the accounting theory hat. Like let's look at what the underlying asset is doing and what it was received for. So even though crypto and digital assets are seen as property, if you earn them as income, you're going to report them as income, right? If you earn it in the course of a W-2 job, instead of receiving, fiat money, US dollars, and you receive Bitcoin, you're going to record that in your records personally as a property asset, and you'll have capital gains on that as you move it. But the initial receipt of Bitcoin is going to be an income item on your tax return. So you should receive a W-2 that equates to the fair market value of the Bitcoin on each day that you received it. So additionally, let's talk a little bit about taxable events and what constitutes a taxable event. So the sale or exchange of cryptocurrencies. So this is a big misnomer in the industry where some people think that if I haven't cashed out to fiat, I don't have a taxable event, and that's just simply not true. Swaps. So we talked a lot about DEXs and automated market makers on the last call, and it's important to note that crypto to crypto swaps are a taxable event. You're disposing of one asset and you're buying a different asset. Now, we had another session on opinion letters and how those can shape how you file and how you take different positions. But we're talking today just generally on what the kind of guidance has been. So if you use your crypto to pay for goods or services, if you bought land with Bitcoin, that's a disposal of your Bitcoin because you're purchasing it. You're purchasing a new asset. You're getting rid of that Bitcoin and you're purchasing something else, right? Also, when you convert back to fiat currency, that's a disposition of that asset. So you are now kind of going back to like the US dollar, for example. So those are all examples of taxable events. So as I alluded to, we're treating this as property. So that means that we look at capital gains and losses when we have these dispositions of these assets. So taxpayers will report their capital gains based on their holding period. So if it's short term, it would be a year or less. And then for a long-term holding period, we have greater than 1 year. So this is going to impact the percentage taxation that you have. We have favorable tax rates for the longer holding periods. And so I know that Sharon Yip is going to be doing a call on tax planning and things like that. And so that's one of the strategies is holding period, increasing that holding period to get into the lower tax brackets, right? And then finally, so kind of just rounding this out, the IRS has put front and center on the first page of the 1040 a question as to whether or not you hold virtual currency or digital assets, right? So they're focusing on compliance here. They want to make sure that people are having to check a box whether they have or have not transacted in these digital assets, and you can see that they're really taking enforcement seriously. So I'd love to open up to Nick for any comments on that or anything that you're seeing related to that sort of stuff.
Yeah, I think that box is really important, right? If you check no and you do hold virtual currency, you've just committed a misstatement on a tax return, which could be a fraud, a big badge of fraud, particularly if there are other things. So I think that's really important for people just to, not just check, in that showed up in other areas too with offshore accounts and stuff like that. And people would check the box no. And that led to be a fact that was used against them when they came compliant. or they got audited by the IRS. So really important to be honest. Check that box. Yes, if it's yes. No, if it's no. Taylor, the fact that they have all these criminal investigations kind of in their in their fold, so to speak, is scary stuff, right? A criminal investigation can be ongoing, and you may not know about it. They don't have to announce that they are investigating you until they get to a certain point, in which case they have to give you your rights and do all that kind of stuff. By then, they've already made their case, most of the time. So that's very concerning. I think it was a good thing that it was classified as property, right? That means you get long-term capital gains if you hold it for more than a year. The big difference there, short-term capital gains is the same as income. So that's income tax rates. That's probably in the 30s. Whereas capital gains is between 15 and 20. So it really lowers the tax a lot by keeping that for more than a year.
Exactly.
Yeah.
So kind of getting into what their enforcement strategies have been so far. So and kind of how they're handling this. So they look into they do a lot of data analysis, and so they have uh things like Chainalysis or other on-chain tools that help with um identifying individuals on chain, even if they may have kind of a pseudonymous nature. So the way I like to think about this is essentially, I would say that the vast majority of folks on chain, especially in the US, have KYC'd at some point. So by that, I mean, know your customer. They've provided either a driver's license or a passport to a centralized exchange so that they could on-ramp fiat currency or off-ramp cryptocurrency that they've acquired elsewhere. So if you have provided KYC information at any centralized exchange at any point, you're very likely to be identifiable on chain, even though there's a pseudonymous nature to the digital asset space, right? We have public keys. You can view, if you know what my public key is, you can look at my account balance and you can see all the activity that I've made. And if you can then tie that wallet address back to an exchange, you can query that exchange or do a John Doe summons or things like that. We'll get into that later on in the presentation, but you can get information about who has interacted with that exchange. So there's a lot of misinformation out there about how anonymous blockchain is, and in order to off ramp in a lot of cases, you will need to provide that information so you are identifiable to some degree. So the
Taylor,
IRS
shouldn't we
is,
just say
yeah.
that it's not anonymous at all? Isn't that the truth of it? I know that was the rumor, but the truth is there's nothing anonymous about it at all. The information's all there.
Right. The only instances I can think of where you would remain anonymous, or at least it would be more challenging to identify you, because you can even look at the IP addresses from what I understand, and you could look at, you could just, it's just data on chain, right? So I think you're right, but there are instances where, like, let's say I bought 10,000 Bitcoin from someone, I paid them cash and they sent it to a new wallet address. It would be hard to identify that until I interact with something, but the, for all intents and purposes, most people are going to be identifiable on chain with these advanced tools. So as I alluded to as well, the IRS has been known to issue John Doe summonses to cryptocurrency exchanges to obtain information on users who have high value transactions. So can you talk a little bit, Nick, about John Doe summons and kind of what that means and what that entails?
Yeah, a John Doe summons is a summons that is seeking information that the IRS doesn't already know about, right? And so it's a big open summons that say something like, provide the name and account numbers for every account that you manage, or something like that, right? And any account that holds any cryptocurrency, any digital currency, give us those names. And they can be enforced in court. The IRS can really put the thumb screws on to the recipient of those John Doe summonses to make it so that it's not in their interest in hiding the information. It's more in their interest to cooperate, because now it's their company that's on the line, and the IRS can shut companies down, can enjoin companies, can do those kind of things, and make it real hard for those companies not to comply. It's been done in a number of different venues, a number of different kind of tax situations. When the IRS thinks there's something abusive going on, they'll issue a John Doe summons, and then they'll just put all the people under audit, right? And that both affects the exchange. Now nobody's going to want to go to that exchange anymore, and all of the participants in that exchange are now suddenly under audit, and you can't hide anymore. Now, if you don't give them the truth, now you've just lied, and now it is a criminal fraud case. So it really turns up the heat. And I think that it's important for people to understand that there's, once the IRS turns its muscle towards this, there's really no hiding, right? People are going to get found out, and basically the IRS will make it worse to not come forward than it is to try to play games and remain under the radar. That's what they did in an offshore world, and it's so expensive not to comply with the basic information requests that it just destroyed it.
Yeah. I mean, I got notified by Kraken that I was part of a John Doe summons, maybe in the last like 3 or 4 months. I had a lot of activity on Kraken in 2021. I was, working in the space and was off ramping a lot of funds through Kraken. And I'm sure that, there was some threshold that I met that initiated that with the IRS. And, I work in this space. I'm a crypto tax reconciliation specialist. So, I filed my taxes properly, but now the IRS has some info backing up what I already reported to them in my 2021 tax filing. So for those who aren't reporting, or who maybe, I would also love to get your thoughts on people who fail to check the box, because, I don't know if that omission kind of has any repercussions, but I know that it is in a lot of tax filing software, they won't let you file your return without checking that box. So would love to get your thoughts on that real quick.
They're going to do that match, right? Now that
Yeah.
they have data, it's very easy for them to run that data. They'll run that data on every John Doe summons name that they got. And then if they didn't check the box, now they'll put them under audit, and potentially that's a fraud investigation. If they did check the box, then they'll look at those numbers. Do they make sense? How big are they? They'll want to start with the bigger fish, because they'll think that there's more good results there for them. And they'll just do a bunch of data mining. They have a hard time finding things, just out of the blue, needle in a haystack. But once they have a hook, once they have some kind of information, now they have great tools to find all kinds of stuff. And what they'll do is they'll run the name, they'll run the checks, then they'll know every single company that you own, whether those companies file returns or not. They'll know all the money that moves between various companies by wire transfers and all that kind of stuff. They'll get all that data, and they'll just have all this dearth of information. And what they'll do is they'll show up in an audit with that information, and they'll start asking you questions, and you won't know how much they know. But I guarantee you they know a lot more than you think they do. And if you then say, no, I don't own any companies, and they have all these, that now you're in even bigger trouble, right? And so it's a slippery slope.
Yeah. And it just kind of it elevates that need for proper reporting there as well.
For
Very
sure.
cool. Okay. And then, so some other enforcement strategies, they're using CP notices. So this is kind of similar to what we were talking about before, where we were seeing, if there's a John Doe summons and then they realize you didn't check the box, now they're seeing a discrepancy between the information that they have, whether it's from 1099s or these John Doe summons or whatever, versus what you reported. And so that's what a CP notice is. It's basically informing the taxpayer. Correct me if I'm wrong, but if anything I'm saying is wrong, Nick, please jump in. But yeah, so they're showing you, okay, this is the data that we have received from a third party, and this is the data that you reported, and it's not matching up. You need to let us know why, and so yeah.
And those are oftentimes what are known as compliance audits. They're just kind of handled by the computer. And those are low-level audits, right? And they can use those audits then to determine if they need to do a full audit. So the failure to comply with that low-level audit could lead to a full-blown audit as well.
And I'm sure there's a ton of low hanging fruit here too, where it's just like, it's an easy, like, oh, this is someone who's a whale that just hasn't been reporting because they thought this was anonymous. And we can see that there's millions of dollars of outflows from Coinbase or Kraken or whatever exchange they're using, and they're not reporting it. It's like easy, kind of let's go after those guys first, pin those down. And then, it just makes things easier to kind of initiate, right?
For
So,
sure, for sure. And look,
yeah.
they can go and they can go back too, right? They get an indicator in for 2022, and then they start asking questions like, well, where'd you get the money to buy that crypto, and how long have you had it, and stuff like that that could lead to other bad facts, right?
Right.
They're not gonna,
And
they're not.
extending the statute of limitations too, right?
That's
That
right.
window gets longer as more stuff comes out, and as the discrepancies get greater and the level of scrutiny gets greater as well.
That's right. Yeah. And CP, there's a CP notice is very general, right? It's a very general notice. There's all kinds of CP notices that get sent out, all kinds of CP 504s and CP this and CP that. And they use it for all different kinds of things. And it is a sort of a computer generated notice most of the time. And it itself is usually not that alarming, but it can lead to alarming things.
And then finally, we've got international cooperation. So the IRS is cooperating with tax authorities in other countries to share information and enforce compliance. So I'm not exactly sure to what extent that is. Maybe you can elaborate, Nick, on like what that looks like in a practical sense.
Yeah, we have treaties with most countries out there, and those treaties basically say that that they will cooperate, and that we can, IRS can seek information through the way that the treaty explains to seek that information and get that information. There will be information sharing between the two. There will be tax relief between the two. If there's a treaty and you're taxed in a foreign country, generally you're not also taxed in the US on that same money. Things like that will be all set forth in that treaty. There's some countries that we don't have treaties with, the offshore world, right? And in those countries, there probably is not information sharing, but also there isn't non-recognition of tax in those countries as well. So sometimes those countries are great until the curtain gets pulled back, and now you don't have the benefit of a treaty to protect you from various things that could occur.
Awesome. Yeah. So now let's move into compliance issues and reporting. So, the identification and tracking of transactions, as we know, we alluded to the fact that you can find it's a public blockchain, right? In most cases that people are interacting with, so you have this paper trail that exists, but it's also difficult from an accounting and tax perspective to translate that into first of all, to compile all the data to make sure that you have complete data, and then also make sure that you're reconciling that all back to the reality of what happened, right? So digital assets can be transferred across various platforms, like via bridging and wallets, and it makes it a bit of a convoluted mess to unwind. So that complexity is compounded when dealing with decentralized exchanges and privacy coins, or things like Tornado Cash, which was a mixer on the ETH. It still is a mixer on the ETH network, where you basically send funds in and it gets distributed out so that it masks the paper trail on chain. And so there are these tools that allow for this to become more convoluted and more complex. So this is kind of one of the challenges that the IRS faces, and those that are involved in the industry from a tax reconciliation perspective have challenges with.
And Taylor, let me say this:
go ahead.
That complexity, sure, that's the IRS's problem, but that's really the taxpayer's problem, right? Because the IRS will just go through and add up all the sales and go, okay, you sold this much in Bitcoin, that's income to you, prove it's not. And now it's your problem to show why that complexity, proves that you don't have as much gain as the IRS thought they did. But it's not their job to prove basis. It's not their job to prove losses. It's only their job to prove income. And they'll just grab all the sales and say, that's your income, unless you can show it's not. And now it's the burden of the taxpayer to prove them wrong.
Exactly. And that's why it's important to keep really good and solid records. So additionally, other challenges here are valuation of digital assets. For those of you who have like looked into kind of less liquid or illiquid altcoins, or just any cryptocurrency project that's outside of the top, let's say 500, those prices from different, you could have prices on Uniswap, which is the decentralized exchange, that are very different from that of a centralized exchange like, Qcoin, that's a more obscure exchange outside of the US at least. Those prices could be very different because of the liquidity differences, right? And the depth of the liquidity there is going to be different. So what do you use as your line in the sand for how you value this digital asset? It's a really important consideration to make, and it makes things challenging, as we all know. So determining the fair market value for tax reporting purposes is a major challenge here.
And Taylor, I would just say the facts are really important, right? If you
if
you have a currency that's very transferable and you've gone to some non-transferable valuation method, that's not going to fly, right? The underlying facts are really important in determining what the proper valuation is.
Yes, exactly. And so like, I think I used the example on another call. I found like something in the 2000s range of the cryptocurrencies, and it was like Yoda coin or something like that. And the 2% depth, which means how much is needed to move the price by 2% was like $3. So if you transacted $3 worth of that token, you're going to move the price by 2%. And so something like that, you're not going to be able to reliably use that pricing for it, because it's just, there's not really anything based in reality. So you kind of have to find out, you have to figure out ways to tie back to something. So you could use a source like CoinGecko or CoinMarketCap that provide on-chain market data. So that could be one way. You could also use like block explorers like Etherscan or Polygon Scan or whatever chain you're using. So different methods there, but also another challenge here. Additionally, so determining the taxable event. So I know we talked about what initiates a taxable event or what causes a taxable event earlier in this call, but there are some issues where it's the gray area, right? I know that some people, I think there's there's an argument to be made that wrapping tokens doesn't really create a taxable event, because you are locking up one asset and wrapping it in a smart contract for use on another blockchain. So you're not disposing of that asset, you're adding utility to it. You are converting it for use on another chain. I think of it like the way, if you took physical cash in your pocket and you deposited it into an ATM, you're not disposing of that cash. You're adding the utility of being able to have it as a digital dollar now that you can then transfer more easily across borders, or pay someone instantly, kind of thing, that you don't need to be next to, right? So I guess all of this is to say that the taxable event side of things is more gray than I think, I think a lot of us realize it's gray, but it's challenging sometimes to determine when a taxable event occurs. Now we have frameworks for that. The Bitcoin Cash hard fork was an interesting example, because when the chain forked, people received Bitcoin Cash, but there are some people who are holding their Bitcoin on an exchange that didn't make that asset available to them till a later date. And so the recognition of income, because this is kind of like an airdrop, right? It's not technically an airdrop, but it's a hard fork that resulted in new tokens, right? In that instance, you've got value that, if you received it as the fair market value at the time of the actual hard fork, that value is going to be very different from when it was made available to you a month or two later on Coinbase, when the price had come down significantly. So really important to know the details of what's happening underneath here. And it's another thing that adds to the complexity of all this. So finally, cost basis tracking cost basis across different platforms, exchanges, blockchains, all that stuff is really challenging. And so it adds to the complexity of all this. So I think we got, okay. So now kind of getting into some more things, record keeping. So the IRS requires detailed record keeping for all digital asset transactions, including the dates, values, and other relevant information. However, not all platforms provide comprehensive transaction histories, and users may not maintain adequate personal records. So, I think it's Binance. I've tried pulling like older data from Binance or KuCoin or stuff like that, and some of these non-US exchanges, they make it sometimes challenging to access your old data. So that's another compliance challenge that both users and the IRS come up against. In this case, it'd be more on the side of the user. But yeah, I don't know if you have any thoughts on that, Nick.
It's always hard to prove basis
Yeah.
on all assets, businesses and different assets, because it started long ago and it things changed over time, and it's just kind of hard to do that. I would say maintain your records for at least 6 years, and don't throw your paper away. Write down information as you get it. You're going to create what's known as a contemporaneous record. That's going to have value if that's the only record that there is. Keep that information for at least 6 years. 6 years is the general statute of limitations that applies on audits that are not criminal audits. Criminal audits can go back to the beginning of time, but there's something called a substantial understatement of tax that can go from a 3-year look back to a 6-year. And so holding your information for 6 years is always a good idea. And if you're not getting a paper copy, make one, right? Make a paper copy, write down the information, write the date, write, all the relevant information, where you are when it occurs, all that kind of stuff, because you're making a record that could hold up in court.
Yeah. So the key thing here is that like a lot of these centralized exchanges, although it seems like you're in crypto, when you have your crypto on an exchange, a lot of them have most of them have internal ledgers they're keeping everything that's not necessarily viewable through an Etherscan, right? You can't like plug in the confirmation code that you got for your purchase of BTC on Coinbase on the Bitcoin block explorer that you're using, because it's an internal thing within Coinbase. So having a record of this, and especially like I was alluding to before, on exchanges where it might be challenging to get that data later. I know I've heard a lot of people having issues getting data from some of the failed exchanges and lending and borrowing platforms that all went under in 2022, whether that's Celsius, BlockFi, FTX. It's important to download this stuff so you have it. Obviously, the stuff that's on chain is going to be on chain, but you still need to maintain your records of what the description of those transactions are. So, downloading the CSV files from those block explorers and having detailed notes, or if you have a portfolio tracker and you're just monitoring your activity there, that can be a helpful place to keep that information. But make sure you're getting backup records of that stuff so you can prove it all to the IRS.
And it goes back too, right? It could be you had a crypto or some digital currency 10 years ago, and then you bought something else and you bought something else and bought something else and bought something else. Your basis was established in that 10-year ago very first purchase, right? And so you might have to go back quite a bit to get to the right information.
Well, I'm working with a client right now that he has a bunch of his private keys from when he first got in back in 2017 on a PDF. And because he doesn't have the private keys to those on hand right now, because it was encrypted and he lost the password to it, I'm having trouble reconciling some stuff in 2023, 2024, because as you're alluding to, that cost basis information was established back in 2017. So there's wallets that we haven't included because the client can't access those private keys and the details that's contained within that PDF. So really important to keep that stuff, and it does have an impact down the line. Now, it may mean that just on some of the assets that he disposed of in 2023 that we have to report a cost basis of 0. That would be the way to get around this. But you want to avoid that as much as possible because you don't want to be overpaying on your taxes more than you're legally required to, right? So getting into a couple more compliance issues, I want to make sure we're good on time. We're a little bit behind schedule on this, but so I might run through a little bit of this a little bit more quickly. But so with DeFi platforms, these present new tax reporting challenges. I know our whole discussion that we just had with Jason Schwartz was all about like DAOs as tax entities and LP. Are these smart contract platforms that are operating without the use of human? I guess they've been established by humans, creating these automated market makers and these decentralized exchanges, but there's a lot of nuance and complexity going on with, are these taxable entities themselves, or are who are you disposing your asset to? So there hasn't been established guidance on how to treat something like an LP token, a liquidity pool that you're interacting with, right? And so this gray area creates additional kind of challenges for compliance as well, because if you don't have clear guidance on how to report it, you have to use your best guess. And the key here is documenting how you're treating things and using that same rationale consistently, right? If you don't have clear guidance from an authority on this, establish an internal way that you're treating this and treat it the same way for every transaction of that type, right? And then the regulatory uncertainty. So we've seen regulation by enforcement with the SEC, and we've seen FASB come out with some guidance, but they've also punted on things like wrapped assets and other items as well. So we kind of have to deal with this regulatory uncertainty. Hopefully, with the Bitcoin ETF and the upcoming hopefully Ethereum ETF, we might force Congress to make some. I think that we have a stablecoin bill in the works, but getting more clarity on this would help to kind of increase compliance and all of that stuff as well. So just getting into the scope of this problem, of the non-compliance problem, this is just data from 2022, but just kind of with some conservative numbers here, we could estimate the individual tax prep market at about $5+ billion, and that was 2022. We're a lot bigger now, and I think with the ETFs, you're going to see this market and this opportunity expanding. So you can see on here and in the resources tab kind of how we get to our numbers, but this is a massive market here that we're all serving, and there's plenty of room for us all to play in it. So getting into assisting clients. So how can tax folks and resolution specialists help assist clients with problems with the IRS? So we can help clarify tax obligations. So tax resolution specialists can help clarify a taxpayer's obligations regarding digital assets, including capital gains, income taxes from mining or staking, and other applicable taxes. You can also help by amending past tax returns. So if your client that you're taking on has had, maybe they had digital asset transactions in prior years, and they hadn't found you and your expertise yet. So they had a CPA that either filed this incorrectly, or I heard a couple of stories of CPAs not wanting any of the reports that folks got from the crypto tax prep softwares, but just wanted to receive the 1099s because there are some CPAs that still think of 1099s as like the gold standard of information for taxpayers. But anyone who's worked in crypto knows that these 1099s that the exchanges are issuing most of the time don't have all the data that they need to present accurate information, because the centralized exchanges aren't required to go out and look on chain and investigate you to find your basis. That's on you to prove. So they're just reporting this 1099 information on what information they have within their narrow view. And so oftentimes those reports that get sent to the IRS are very different. And so this creates a huge problem when you don't check the box, or you check the box no, and the IRS gets that 1099 information that maybe has stuff listed at a much higher value than it and gains than it should be, because that exchange is not capturing your proper cost basis. So additionally,
Taylor, the IRS 1099s are not self-authenticating, meaning they would have to call a witness in court to authenticate the 1099. But once that 1099 is authenticated and it has all of the sales on it, but it doesn't have basis, doesn't have losses, doesn't have the things that are good for the taxpayer, right? So it would get authenticated to the detriment of the taxpayer, and then they would have to prove the other things that aren't on that 1099. So that isn't like the fact that those 1099s are deficient doesn't stop the IRS from using them.
Right. Yeah. I mean, working at a company that did a lot of launches and things like that, a lot of my activity was on DeFi in 2021. And so, the IRS sees a lot of the stuff that's coming through these centralized exchanges, but it's missing 90% of the information that backs that up. And so, I have my ducks in order, but I expect to get at least a notice or something like that relating to 2021 or 2022 myself, because I know I have a bunch of DeFi stuff that isn't captured by those 1099s that were issued. So, yeah. And like you say, it's to the detriment of the taxpayer because it looks like you had a lot more gains than you actually did. So additionally, we can help clients navigating IRS notices and audits. So specialists can guide taxpayers through the process of responding to IRS notices related to digital assets or representing them in audit, ensuring that their rights are protected and they're compliant with tax laws. So I don't know if you want to talk a little bit about that, Nick, at all.
So I just say this, sometimes this person who prepared your return is not the person who should be representing you in an audit. That's not always the case, but sometimes that is the case. For example, let's say the box didn't get checked but the IRS knows that there is digital currency. Now they're going to ask the preparer, well, did they tell you that they had digital currency? And now the preparer is in an interesting situation because either the preparer is going to be in trouble or the taxpayer is going to be in trouble, right? And that kind of stuff happens quite a bit, actually, where the preparer gets put into a position where they can't really answer the question without hurting the taxpayer or hurting themselves, right? And so think about, for you preparers out there that are on this call, think about whether you should be representing that client in that audit for that return you prepared. And you might not want to do that. And then I'll just say this, in audits are fishing expeditions. That's all they are. The IRS is fishing for everything it can find. And the smaller you can make that expedition, the better. Audits, you don't have to win an audit. An audit doesn't end in a win or a loss. It ends in a proposal that you can challenge. And so a lot of people get stuck in this idea that they have to win these audits. I don't care what the audit says at the end, so long as I've limited the scope of it and not, allowed a big expansion to other things. And because you can take it to the next phase. And if there's a bunch of stuff in there that's just stupid, that's good for you. That's good for you in the next phase. As a matter of fact, you don't want to correct that, right? You want to leave that stupid stuff on the audit notice. You want that to be part of the case moving forward, because now somebody else has to look at it. And when they see all that stupid stuff, the revenue agent just lost credibility, and you're going to do a lot better in settling that case. So really important to know, you don't win audits. The way you win an audit is by having it end. Yeah,
exactly. And so that's why that lends to the importance of really clean documentation and records. Is now you can justify. So as tax preparers, we need to be prepping these returns with as much information included to not only cover our client's ass, but to cover our own ass, to say, hey, we've asked these questions. We've determined that we've reconciled this all. Here are the positions we took and why, and all of this. So it's really important stuff. So tax resolution specialists can also help with resolving over or underreported income. So whether that income or those gains were overreported because the prior CPA didn't know what they were doing, and they were lazy and they didn't go after the resolving any cost basis issues. So the taxpayer maybe reported way more gains than they should have because they had a lazy CPA, or one that was just wasn't up on their training. Also, unreported income. So if you had stuff that maybe you didn't realize needed to be reported because you're one of the folks who thought that only when I cash out did I need to report. But now your new CPA has educated you to the contrary, that no, you do have to report that stuff. And now you're going back and you're kind of correcting the error in good faith, right? Additionally, we can advise on tax payment plans. So whether that's an offer in compromise or just a payment plan to get that balance paid down in 5 to 10 years. We can help with those items as well.
And one thing that's good to know about on payment plans is this. A payment plan isn't in your interest unless the IRS is forcing you to do it. A lot of people rush off and they go, oh, I got to get into a payment plan. Well, guess what? If you owe over $50,000, that means that you have to file a notice of federal tax lien to get you into a payment plan. And once you're in a payment plan, now you're going to pay interest and penalties first. If you don't get in a payment plan, you can pay tax first, and you may be able to avoid the filing of a notice of federal tax lien. So just jumping off and getting yourself into a payment plan from the start isn't always in your interest.
Mm-hmm. Good note there. So some other ways we can assist clients is offering representation in disputes. I know that Nick, you guys do that sort of stuff, right, Nick?
Yes, sir.
Yep. And so Nick can be in your corner to help you resolve those things in front of the IRS and advocate on clients' behalf, as well as educating on record keeping. So we've talked a lot about keeping good records and how important that is in this whole process. It's our responsibility as tax preparers to educate our clients on how important this is and get them into better habits, because those of us who have tried to unwind a mess from years back, if you're just looking at 2022 or 2023, you need to go back and you need to look at everything from their inception on chain to be able to get the information correct. So the better documentation your clients have, the better we'll be able to help them. So additionally, we can help assist with complex transactions. So being a phone call away for our clients to be able to, if they're about to enter into a complex new trade or a complex new DeFi instrument that's just kind of gaining popularity, they can lean on the expertise of a tax resolution specialist with regards to crypto to get advice on that sort of stuff. And then additionally, just staying abreast of the changing regulations, that alone is a full-time job. So kind of finding a network of people that can help you stay on top of the changing regulations in crypto. It's, for those of us who are stimulated academically, like I think that's a big reason why we're in this industry, is because we do like the change and we do like the agility of this industry, because it keeps things interesting, right? So providing that connection to the industry for your clients as well is really important.
Hey, Taylor, let me just add, there's
Yeah.
a process to hire a CPA or an accountant, and to get that professional under an attorney-client privilege. There is no attorney-client privilege for a CPA and a taxpayer. And if you're in trouble, the government's star witness is probably your CPA. But if you have a lawyer that's representing you, the lawyer can hire a CPA to do work for you, figure out complex transactions, do all those kind of things. And if the lawyer has hired the CPA, now that's subject to attorney-client privilege. It's called a COVEL, K-O-V-E-L arrangement. And it's really important because, like I said, CPA is oftentimes the government's star witness, right? Because there is no attorney-client privilege there. So you got to be really careful, both on the CPA and the client side. If there is potential criminal exposure, anything that's, got some hair on it, right? Hold on, let's get a lawyer on the phone, right?
Exactly. Yeah.
Because you're not protected.
Right. So yeah, being aware of that from the tax preparer side, that your client may be or about to incriminate themselves, that would be an instance where you might want to give Nick a call and say, hey, let's stop here and continue this conversation once I've been hired by Nick or brought on by him, so that is a additional layer of protection. Really nice nugget of information there, Nick. Thanks for that. So we're running close on time. We got Adila who has, I haven't checked the questions yet, but it looks like Adila has a question. Do you want to drop that in the Q&A section, Adila? Because I don't think we have speaking on this type of event. I don't know if we have speaking enabled. So if you can just drop your question in the Q&A, I'll make sure we get that answered. So we're getting close on time. So I just want to get through this last couple of slides. So back in 2014, I actually, I'll let you kind of lead the way on this slide, Nick, if you don't mind.
Yeah, the I don't know probably worked way back when. It doesn't work anymore. The IRS started putting out published guidance in 15, right? And now you're bound by knowledge of that published guidance. So that's not going to work anymore. And that published guidance puts digital currency holders on notice, and it put forth certain things that you should do in order to come into compliance. Those are important. Additional things that could, a simple I don't know case isn't really a criminal case, but if you've taken steps to hide that, that starts to look like a criminal case. If there's an offshore entity that you're using in an offshore jurisdiction that you didn't disclose, that's another issue. By the way, those offshore companies require disclosure as well, right? So now they've got you in two situations where you didn't disclose. Now that's starting to look like a criminal case, right? Use of multiple entities is a classic tool that can show up in a criminal investigation as a tool being used to hide something. False statements are classic, right? And then the process, right? If a guy with a badge shows up and a gun, that's a bad sign, right? That means that's a criminal investigator. You don't want to talk to him. The only thing you say to them is, so-and-so's my lawyer, and that's it. There's nothing that you can say to a criminal investigator that's going to help you, period, end of story. But the only thing you can say is, I'm represented, please talk to my lawyer. The lawyer can always tell them those things that you want to tell them, but you don't want to just start talking because they're not there to help you. They're there to finish off their case and make sure that they can convict you criminally. If somebody shows up, they've already made the determination that you're a criminal, and they've got good evidence to show it. And now they're just looking for the icing on the cake, which could be a false statement that you then make. And now they've really got you.
Absolutely. We do have a couple questions. I'm going to jump to this slide just so we make sure we get to it. But just real quick, Adila wanted to know about the event of assets being frozen and what happens in these types of cases, especially by an exchange or bank. What can clients do from a tax perspective to better avoid this type of occurrence? So if you are if you're on chain and you want to protect your assets from being frozen, you can store them in cold storage. Or on a hardware wallet. This would protect you from that because this type of cold storage, there's no way to freeze it. Now, your wallet address may come under scrutiny, and it may come up on you might get sanctioned for your wallet address. And in that case, if you tried to transfer to a centralized exchange, those assets could be seized in that event. So I'm assuming that that's what you're asking about, Adela, in those cases. And I mean, in that event, the way that you can avoid that, I guess, would just be to not be involved in any illicit activity. But yeah, I think that could you elaborate a little bit, Nick, on how you might go about, or what strategies you might look into if your assets do get frozen on an exchange?
Yeah, well, I think that's not necessarily the IRS at work. That's the
Right.
exchange at work. Although,
Right.
if the IRS issued a levy to the exchange, then the same with a bank, the requirement is that you take the funds out of that account or the cryptocurrency out of that account and you segregate it into a general account, and then you have to wait 21 days. During that 21-day period, the owner of the account has a right to contest the levy and challenge it and do what they want to do to stop it from happening. Generally, the banks and the exchanges, they want to pay that money over, right? If they pay that money over and it shouldn't have been paid over, they're sort of insured, so to speak. But if they don't pay it over, now they face really stiff penalties, daily penalties for failure to pay those funds over. So they want to get those monies over quickly. If it's during that 21-day period is really the only chance to stop that from happening. And once that money ends up in the IRS's hands, it is hard to get it back, right? So if that happens and there's reason that money shouldn't be paid over, you need your lawyer working right away on stopping the bank or the exchange from paying those currencies over.
I'm sorry, my monitor just got disconnected real quick, so I'm trying to bring back up the presentation. For those of you who want to jump to the next call is starting. We're going to finish this call here, but you have done your requirements for the 50 minutes on this call. So if you were looking for your CPE, you have accomplished it. But if you want to stay on, please stay on. We're going to finish this discussion. But if you want to jump, you can jump as well. So I just wanted to give people the heads up on that. So I'm just going to reshare my screen. Just give me 1 second.
Let me say
Technic
this about putting assets out of the reach of the IRS. That itself is a crime. And so a lot of people do things like that. But if you've done something like that and you owe the IRS money, now that looks like structuring, and that can be a problem. If you're doing estate planning and doing those things before there's an IRS problem that comes along, that's a totally different story. But once you've got that problem, be careful, right?
right.
And then the other thing is to say is that, if you do have things sitting out of the purview of the IRS, they just focus on the things that are in their vision, right? And they just make it hell for you to do anything. And next thing you know, you're volunteering to pay those amounts over that they couldn't get to, right? And so they'll just make it really hard for you to function. And one thing that really gave them a really strong tool for that is taking your passport away.
Oh yeah,
You
huge.
see that happening to a lot of people who have debts. They just take your passport away, and now you can't get in or out of the country, and now you're stuck, and now you got to deal with them. So
Um, so I think we talked about John Doe summons already. I'm going to
yep.
just jump to the next slide real quick. Um, the crypto audit. So sorry, this I had two screens open, so it was a little bit easier. Now it's a little challenging. Okay. Um, so can you just talk about this and what it would look like?
Yeah, so there's a voluntary disclosure program out there. There always is, where you come forth and you voluntarily disclose. Generally, it takes 6 years of amended returns, and if it's an official program, that will generally trigger an audit of those 6-year returns. What you get for that is get out of jail free card. But there could be civil penalties, and there could be taxes that come out of it. And then just, some taxpayer basics there. Look, if you're under audit, it is your obligation to answer the questions that they ask you. Nothing more. Don't volunteer. You don't have to volunteer information. You don't have to tell them anything that they're not asking you. You just have to answer their questions truthfully. If you are in a situation where answering questions truthfully is going to be a problem, hire a lawyer, right? You need somebody between you and the IRS in that situation. And, lawyers have to answer questions truthfully as well, but it's a lot easier for your lawyer to say, I don't know, than it is for you. And then if what most lawyers will say is, I don't know, please put your questions in writing and I will answer them in writing. And guess what? The IRS oftentimes doesn't put them in writing, and then you don't have to answer them, right? And so there's a lot of little things that tax lawyers can do to get out of answering difficult questions. They don't always work. And sometimes they work in the opposite direction. Sometimes they work and it makes the agent want to open up other years. So it's a bit of a delicate dance. But it's hard if you are facing those questions personally.
Yeah.
So yeah, be careful. This slide, Taylor,
We talked
collection,
a lot about it already, right?
right? 10 years, right? Once there's an
Yeah.
assessment, 10 years to collect from you. If
Yeah.
you are doing certain things like filing offers in compromise, guess what? It'll extend that 10 years while that offer is pending. So all of those ads that you hear out there when you have debt that want to file offers for you, they're happy to file an offer for you in year one. But guess what? You're never going to get an offer accepted in year one. And it's just going to take that year or 2 years that it takes for them to say no. And now, instead of it being 10 years, it's now 12 years. And so be very careful, and talk to somebody that knows what they're doing before you just start to do things with the IRS, because it could end up hurting you.
Absolutely. So just in conclusion, wrapping things up. So there's a massive gap in reporting for both taxpayers, and so it's really important that people get on top of this, because these CP notices are going out. We're seeing lots of people getting these, and I think that it's only going to increase, especially with us entering into another bull market. The IRS wants to get their cut of all of this, and they're taking digital assets seriously. It's a major revenue opportunity for the IRS, and because it's a major revenue opportunity for the IRS, it's a major revenue opportunity for tax practitioners to help clients, right? And what compounds this is that reporting is complex. So being ahead of this is going to make your skills that much more valuable. And you see it in people all around the industry. We all are basically turning away clients because there's more work than there are individuals serving. So I just wanted to get to one more question we had. It was from Chidi. I hope I'm pronouncing your name properly. What material state tax implications have you encountered?
Well, the states all have information sharing with the IRS. And so once there's an IRS liability, they inform the state. Now you have a state liability. It goes the opposite direction as well. If the state finds out about you first, they'll let the IRS know. And now now you have an IRS liability. So they tend to go hand in hand.
Okay, great. Well, that wraps everything up. We went a little bit over, but I mean, it was well worth it. We had an amazing speaker on today with Nick. Thank you again, Nick. And if anyone wants to reach out to Nick, what's the best place to get in contact with you?
Yeah, I'll give you my phone number, 720-370-1169. And my email is my name, Nick.Richards at gmlaw.com. GM stands for Green Spoon Martyr, my firm. And I'd be happy to talk to anybody that needs help.
Awesome. Well, thank you so much, Nick. And thank you everyone who joined. We will see you on future presentations.
Thank you. Have a great day.
All right. Bye now.